Treasury announces another round of buyback program after yields hit multi-decade highs. Here's what that means in plain English. Long-term Treasury yields had been climbing for weeks, and this week the 30-year bond hit a 2-decade high of 5.33%. That's a big deal because those yields are the interest rate the US government pays to borrow money over decades. And when they spike that high, it usually means investors are getting nervous and don't want to hold that debt anymore. Basically a quiet buyer strike on the longer end of the bond market. Rising tension in the Middle East and inflation ticking back up only added to that unease. So Treasury stepped in with a buyback. Essentially, the government offered to buy back some of its own older long-term bonds early, paying investors cash to hand them over before maturity. In plain English, when demand for something drops, buying more of it yourself pushes the price back up and pulls the yield back down, which is exactly what happened, with yields easing right after the announcement. This isn't about paying down the national debt, it's damage control, a move to keep borrowing costs from spiraling higher and spilling over into things like mortgage rates and everyday lending.